Greg Dickerson is back. How you doing, sir?
Doing great. Michael, how are you today?
I'm doing well. I don't know if you watch Meet Kevin's stuff on YouTube, but he put out a video yesterday that was yesterday. Yeah, maybe it was Saturday, about real estate, the real estate market. Talked about the 1970s. So it kind of felt like he was going after me in my 50-year spreadsheet. But at the end of the video, he talks about what he thinks might happen in the real estate market if the 30-year mortgage rate goes from a low of 2.7 all the way to 5.2%, a 2.5% jump. So I thought you and I should talk about it because you and I have had differing opinions about what would happen in the market with a 1% jump. Let's talk about a 2.5% jump all the way to 5.2%. What the heck happens then?
Yeah, so we've already talked about that before in terms of your buying power for borrowers. I mean, that reduces your borrowing power by 20%, basically. So, 2% rate hike in interest rates over 30 years reduces the loan that you can get by about 20%, in that scenario. So it'll make a big impact on people's ability to qualify, number one, and how much they can qualify for, number two, which ultimately affects the value of the houses that you can buy. And, again, where you'll feel that first and see it first is in new home builders.
Yes.
So new home builders are the first ones to be able to pivot and the first ones that can pivot and react to those changes. Whereas, resale housing stock is generally lagging these things by 6 to 8 months because a lot of them don't have to sell. A lot of them, can wait, and it takes a little while, and a lot of people don't remember. I mean, before the last, I don't know, probably 3 years that the housing market's just been straight up and just kind of going nuts. Average days on market was about 6 months.
Yeah, it was much longer.
Average days on market, people panic now if the house is on the market for more than a week.
Exactly. Yeah, something's wrong with it.
Yeah, it used to be 30 days. So that needs to happen. You got to get to where people are putting houses on the market and they sit for 3-4 months. They're getting offers less than asking price consistently.
Totally agree.
Things like that. So it's going to take a while for values of existing housing stock to really adjust. But new home builders, they'll write it off. They'll get their money out because their cost is already generally 20% below what they're selling it for anyways. So they've got that kind of margin in there. So new home builders is where you'll see that start to happen first, and you'll be able to get the best deals.
I think that is very good advice. When I think about rates going up to 2.5%, I think about everything else that must happen. So if an owner-occ loan, 30-year, 20% down, best credit, is 5.2, that means investor loans are probably 6.5, 6.75, right? Which again will sound crazy to anybody who's been doing this the last 5 or 6 years. That is still below my first mortgage. My first mortgage was in the 7s. So we will get back to normal.
Property.
Yeah, for an investment property. Yeah.
Yeah. Oh yeah. When I was, at the peak of my development career, I mean, I was paying 9.75%, construction loan interest. And then investment properties were in the 5s. I didn't have any in the 6s for permanent, but I had them in the 5s. But my construction loan interest was 7 to 9%.
Yeah.
In those areas of high interest rate. The other thing too is inflation. So, if rates are going up, there's a reason. It's because inflation's high. And when they start looking at, your variable rate debt that, consumers have, car loans, credit cards, things like that, that increases and decreases your borrowing power as well. So from an investment property standpoint, if all your costs are going up due to inflation, the performance start to be impacted, the income gets impacted. So lenders are looking at that if you're doing income-based, asset-based lending like commercial and things like that. There's a lot of different factors, like you said, what else is going on for interest rates to increase that much? There's a lot of things going on. Also, credit tightens. So as rates go higher, it gets more difficult to get a loan. They change their borrowing requirements and lending limits and things like that, and that affects things.
Yeah. When I think about the 30-year mortgage on an owner-occ loan going to 5.2, my first step is, because I think you're right. I think the residential market, right? New homes, they kind of reset, they clear it out. They take their couple of losses if they have any, but they kind of reprice the next build out. That's their own thing. And that's a really small part of the market, right? Last year, I think there was 700,000 new homes sold, but 6.1 million existing, something like that. So again, it's 10 or 12% of the market. When you think about existing home sales, you're absolutely right. That market will seize up transaction wise. it will delay and ultimately could lead to price reductions. But here's the wrinkle. What's going on in the economy? What happened? Did we get Paul Volcker 2.0 in the Fed seat and he's taking rates to the moon? Has GDP, gone down -3% because we're in a nasty recession? Is unemployment shot up to 9%? To me, the question is, when you talk about theoretically 30-year rates going to 5.2, my mind goes to what else is broken, because we don't just jump to 5.2 without other things being broken. And my biggest fear is the commercial market who doesn't have fixed rate debt. That's where the pain will show up. That's where the discounts will be, because there'll be a lot of operators that are like, well, guess I can't refi, throw it on the market. So I think we're going to see lots of discounts in multifamily, commercial, office, retail. That's where I think all the pain's going to be. What do you think?
Yeah, you'll see prices in the commercial market adjust instantly, because those are all, asset-based loans, and they're based on the cash flows and debt service coverage ratios. The only way you can effectively change that is to bring more equity to the deal, to get them done. And then that changes the deal metric. So, you can only pay so much, for those deals. And at some point they don't make any sense. And if you're in a declining market where rents are under pressure and they start to go the other way, which, we're seeing pushback in the rental markets already, especially with inflation. You're going to continue to see rent come under pressure. And, some areas are instituting rent controls and, things like that. So, it's a tricky time, but 5% interest isn't that big of a deal. I think we can get there real quick. I mean, what are we at in the 4s today?
Yeah, I think we're just over 4. I think the last time I saw the average is 4.11.
Yeah, that's already having an impact on the market and inventory levels, in some areas, and buyer activity. You get into the 5s, that's going to have a significant change in behavior. And then with all the other, inflation that's going on right now, with, stock markets and other asset markets, deflating and, repricing, that's going to affect people's buying ability and what they were going to use for down payments and things like that. The interesting thing that we never had before that we have now are the institutional buyers, buying rental properties.
Yes.
And they can suck up a lot of overinflated, values of inventory, or inventories that have overinflated values. They can, they're still buying those because they have a 30-year horizon and, doesn't really matter. So that'll be interesting to see.
On that front, I think they're actually going to be the consumers, or the buyers, excuse me, of a lot of the builders that want out. I think the builders will say, hey, I got this complex, it's half sold out, I want to sell it to one person, I'll give you a 12% discount, you buy it all now. Because build for rent is taken off. Lennar is going to do 7,500 units. Pulte Homes has got $1.5 billion set aside. I think the discount for home builders will go to Wall Street. That's just something I put together.
Yeah, and it's already happening. I mean, they're already working together. But yeah, if you get a housing crisis 2.0, that's what we did not have before. That industry was born out of the housing crisis.
Yeah, again, and one of the things, again, I've had these conversations with folks, kind of off the record. In the past, they were buying the 1950s dilapidated, home. They don't want to do that anymore, right? Their numbers that they put in their spreadsheets didn't bear out because of the age of the house. That's why you see them buying new stuff. They prefer to put new capital in new stuff. New to them is 3 years or less. So yeah, they're going to clean up, I think. And again, the best risk-adjusted return the last couple of years has been the single-family home. So Wall Street's very predictable. If it works once, they'll do it again. So that's what I think they're doing.
Yeah. Well, it'll be interesting to see, where this all goes and where rates end up. And I mean, we're pretty close to 5% already. So maybe 6 is on the table. Who knows?
Yeah, I think we get to 5 this year. What do you think?
It's looking that way. And especially if the Fed comes out and they get a little bit more aggressive. I mean, treasuries are already on the way back up again.
I saw that 2.1 this morning.
Yeah. Yeah. So, it's getting more aggressive in that environment. And you're going to continue to see, a rise there. And that's a whole nother conversation with the spread and inverted yield curve and all that. So, there's a lot going on.
Very cool. Well, Greg, this has been always fun, always a great conversation. I'll probably reach out to you Wednesday afternoon after we get the Fed decision just to see what's what. But before that, where can people find you?
Yeah, gregdickerson.com. All my social media links are there, YouTube channel, Twitter, all that stuff.
Very cool. Thanks, buddy.